I'm a mortgage broker. Mortgage rates are my life. That's what I look at every day, every single day. Well, try to take weekends off, but every day looking at mortgage rates, trying to figure out the best deal for the consumer. We typically, our company, Butler Mortgage, advertises the lowest rates in Canada. And that's what we spend our time on, thinking about where we're going to get these rates and what rates are the best deal for the consumer. So, what's the future of rates? What's the inevitable path of mortgage rates in this country? The eventual, inevitable, but bumpy, non-linear path of mortgage rates in Canada, today, fixed rates, we're just going to talk about fixed rates, down. Now, is it going to be smooth sailing? Is every month it's going to go straight down like a gentle slope heading into a valley? No. It's not linear. It's up and down. There's bumps and moves and changes and ups. But the inevitable is down. So why is that? Why is the inevitable path of mortgage rates for the next few months downward? That's a reflection of the bond market. The eventual bumpy, non-linear path of the Canada bond market, the Government of Canada bonds, is downward. It's as simple as that. So, why? Because eventually, there will be a reasonably coordinated move of central banks. That's the Bank of Canada, the Federal Reserve of the United States, the Bank of England, the European Union. Eventually, let's not worry about what happens in China. China's its own thing. But eventually, sometime in the summer, the fall, whenever it is, eventually there will be cuts. Because just as it went up, the central bank rates will eventually come down. Now, I know there's a lot of pushback on this idea. I know there's a lot of pushback. Oh, no, you're wrong. There's going to be another financial crisis. There's going to be this. There's going to be that. There's going to be, oh, you don't know. There's unexpected events. There's a war in the Middle East. There's this. There's that. I know everybody has an opinion. But if you're in the business of doing any kind of analysis, you work based on probabilities. What is the probability of this occurring? The probabilities right now line up to say, because various economies are under stress, if we look at Germany and Great Britain right now, if we look at the States, it seems to be going very well. Canada is just masquerading as okay. I mean, in reality, per capita GDP is on a steady course down. If you talk to people, they'll tell you, yeah, things are a lot worse than they were. The general intuition of the economy is not good. And in the end, we will see these federal and central bank institutions start to cut rates. That's just inevitable. We don't know when. It's not going to be April. It might be summer, might be fall. But the bond market, who are just traded by individuals, moving billions and billions of dollars worth of bonds a day, they are paid to figure this out. They are paid to do the timing. And that's why it's not perfect. Their ideas change on a daily and weekly basis as to when the cuts will start, as to the speed of the cuts, as to the depth of the cuts. And that's how they premise their trades in the bond market. So is it linear? No. Will there be ups and downs? Yes. Will the general trend be down, 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 down? Eventually, we will reach a lower place. Oh, and by the way, the lower price is not that low. There's no more 2% rates. There's no more 1.69 5-year fixed. This is gone. This historical anomaly that occurred back in 2021 is gone. We're not going to see that again. We're going to see rates eventually, 3-year, 4-year, 5-year fixed mortgage rates in the medium to low 4% range. So there'll be some 409s, high ratio. There'll be 449s. There'll be 459s. But there'll be a lot of rates below, lots of rates below 5, lots of rates in the mid 4s. And that's where we will see things develop in the summer and fall. So the message to everybody is, if you're thinking of transitioning from variable, if you're thinking of refinance, if you're thinking about buying a house, those rates are just below 4 today, those fixed rates. They will be lower in a few months. That's the message. That's what we'll see. There's so many reasons why. There's no point in going into them all. The trend is clear. The trend is there. What does it mean for variable? It means for variable that there is always an element of risk. The risk is on you, the borrower. It's not on the bank. When you get a fixed rate, the bank's taking on all the risk. If the risk is on you, it's like in the sixes. Those rates are in the sixes now. They may stay in the sixes till the late summer or fall, and they may come down very slowly. So if that happens on a slow boat down, you might think you're going to get a great deal, a rate in the 4% range out of variable by the end of 2024 or by the middle of 2025. But you might find that to be a very slow progression, and you might have always been better off with a short-term fix like a 3-year. Keep these things in mind. Throw the comments out. I'm wrong, you're wrong, I'm right, who knows? I don't care. I'm paid to understand this. And this is where I believe we're at right now.